Cisco had earnings as well. And as you may remember, they had reduced their forecast in the previous quarter and came up with some pretty nice numbers.
Yeah, so I'll hit on some of the high points, Pat, and I'll let you back me up on all of it. But Cisco had a really interesting period. The stock was super repressed because essentially the company said it was going to be a tough couple of quarters. The sledding for the OEMs from the very beginning of this year, supply chain disruptions, enterprise spending disruptions. Unlike SaaS and some of the cloud players, they saw a massive scale and growth. Companies that depended on big iron, big infrastructure, big implementations, hardware procurement have had to sort of wade through this pandemic a little bit differently. And for Cisco, it's really been putting pressure on the company's performance every quarter, with the exception of a few parts of its business, namely security and collaboration. But it reset the adjusted earnings, and then it did deliver, Pat. And I think that was a really important thing. It delivered on revenue coming 11.93 and delivered on billion, and it delivered on the earnings at 76 versus 70. The other thing, Pat, that was really promising about the earnings call was listening with Chuck Robbins was basically it's planning in this next quarter to get back to a flat year-over-year number. Now, this quarter was a 10% annual revenue decrease year-over-year, and we know how unsatisfied the street is with negative numbers. And even with a global pandemic that had wiped out a third of our GDP in one quarter, people were not happy with anything less than growth. And this is especially true in the tech industry. This upcoming quarter, Chuck Robbins said it's going to be somewhere between 0 and negative 2%. And in my experience has been typically Cisco, they're not a sandbaggers, but they're typically very conservative. So there's a very good likelihood that the company could beat. Now, Pat, a couple of things just to note. The infrastructure business, which is the company's biggest by far, representing more than half the revenue, has seen a pretty significant decline, about 16% decline year over year. And then, the other area being applications, it's saw an 8% decline. So the only real growth area that holistically has grown has been security. And no question that's been built upon the success of companies needing to be able to deter threat, which has become a scaled up occurrence during the pandemic. The one other thing that the company could really talk to, Pat, that was exciting has been its transition from perpetual licensing agreements on all of its hardware to subscription-based agreements that are going to drive greater recurring revenue over the lifespan of hardware deployed. This company is moving to flex consumption. It is planning to move to everything as a service. And that migration to those things, Pat, is going to depend on it being able to build trust for recurring revenue. So those are the three things I noticed. I'm guessing by the look you're giving me that those are all the great things you wanted me to leave for you to talk about. Darn it, I hate when I do that.
Yeah, what is this leaving air for Pat? Here's all I'll say is during a time of COVID, what was up was no surprise, and that was services, and that was security. What was down was no surprise. That's infrastructure. You have to get in there to actually install infrastructure. And right now, IT, that is not high on their priority list. Now, what I'll say to the other side of my mouth is some of the growth infrastructure, the Cat 9K, Wi-Fi 6, did very well. And that's important because those are their brand new infrastructure products. And even though the company is going gangbusters on software and security and services, it still very much makes most of its revenue and high margins on particularly switches.